what I'm going to do tonight is mostly talk to you, but I'm going to read a few passages as well that I hope convey some of what I felt was the drama of the story. Those of you who followed some of my career may know that this was my first history, and for me it was really the most exciting project I've ever been involved in because the people that I wrote about reminded me so much of people on the scene today, and the book is full of controversies that feel like they leapt off the front pages of today. In fact, just last night, anyone who saw the Republican debate may have seen that Ted Cruz came out against the Federal Reserve and advocated a system of going back to gold-based money and presumably not having a Federal Reserve. Tonight, I'd like to tell you what it was like when we actually had a system like that back 100 years ago. But before I get to that, I want to start with something more simple and basic, which is what is a Federal Reserve and why do we have it today? If you think about an ordinary bank, they serve two functions, which are kind of self-evident. For people who don't have enough money, they're places they can go and borrow. And for people who have a surplus, they can go and park it and earn interest. But besides helping out those two groups of people, they serve a larger social function, which is they're a way of getting money that would otherwise just sit there in the, wherever rich people keep their extra money in their basements or, in some safe in their yachts or something, and move it to some place where it's useful to society, where to people who actually have a need for it. So banks fulfill that social function. A central bank is just a banker to banks. Just as some people have excess funds, some banks have excess funds. They may have a few extra $1 billion sloshing around. And they can park their excess reserves in any one of a network of reserve banks around the country, which is what the Federal Reserve is. And obviously, just like some people are in need of funds, sometimes banks run out of money and they can borrow from the Federal Reserve. And we saw that in a big way during the financial crisis in 2008 and 2009, when the Fed became the classic role that it was designed for, the lender of last resort. It's really important in a crisis because what happens in a crisis is it's not only the sick banks that stop lending, but the healthy banks, when they see other banks in trouble, they say, I'm going to pull back, I better stop lending. And you get this dynamic whereby every bank does what it has to do to protect itself, to call in loans, but they're all doing something that hurts the community at large, that is to say, depriving the country of credit. And the role of the central bank is to so-called lean against the wind and lend when no one else is. After the mortgage crisis, my editor suggested to me that it might be interesting and fun to look at what the country was like before we had a Federal Reserve and how we got one. So I plunged into archives, and as I said, this is the first time that I've done primarily, or in this case, exclusively archival research. And that's a really different world from reporting. There were lots of things I couldn't do. I couldn't call up Woodrow Wilson and ask him, why he'd done such and such and so on. It would have been not a very lively conversation. But I discovered that there are things that an historian can do that, or things get revealed to an historian that might not to a contemporaneous researcher. The Federal Reserve Act, the peak of the legislative process was in the summer of 1913. Washington, then like now, Washington, D.C., was a very hot place to live and work. And Ellen Wilson, the president's rather delicate wife, left town for New Hampshire during the summer, which wasn't uncommon for political spouses in that era. And so, since she was in another town, we have the record day by day of what Wilson was writing to her, which committees in Congress were giving him trouble, which congressman he was leaning on, who in his cabinet was giving him trouble. Today you wouldn't have that. The first couple would be in the same city, or they'd be, talking on the telephone and so on. In other ways, the era felt completely similar to now. It was a period of great financial stress. There was a financial crisis. People were very angry at the banks. Many of the banks misbehaved. They were angry at the government. Ted Cruz has nothing on the populace of the late 19th and early 20th century. In that day and age, they were Democrats. Now they're on the Tea Party wing of the Republican Party, but the feelings are largely the same. The people didn't like big banks, they didn't like Washington, and they didn't want Washington anywhere near a big bank itself. And I'm going to tell the story through the eyes of one particular character who had to confront these feelings. And I say confront because he was not an American. His name was Paul Warburg, and he found the attitudes of his adopted country very bizarre, to say the least. But Warburg would play a very big role in the formation, even though he was not an American, of the Federal Reserve. He would later write in his memoirs that his hope was that the Federal Reserve would become a great national monument, as he put it rather poetically, like the great cathedrals of Europe. And his life was really one long struggle to try to make that so. He was born into a very wealthy banking family in Hamburg in the second half of the 19th century. He had 3 or 4 brothers who were involved in the family banking business with him, but he quickly became the heir apparent, and by his late 20s was set to run the family bank. However, at that point, he fell in love with the daughter of an American banking family, Nina Loeb, of the Kuhn-Loeb banking family. They got married in around 1899, 1900, and Paul and Nina at first settled in Germany, but she wasn't too happy living away from her folks, and long story short, they relocated to New York. Very quickly after Warburg got to New York, he realized how different the system in his adopted country was. In Europe, all the banks had their reserves in this central reserve. In America, each bank kept its own reserves. When I say reserves, I mean rainy day money, extra money. And when I say kept their own, they'd keep them in their vault, or they might park them in a bigger bank that paid a little higher interest down the block. So a bank in Tacoma might have kept some of its reserves in a bank here in Seattle. And a bank in Seattle might have then kept its reserves in a bank in San Francisco. But whenever there was tightness, this whole system would back up. The bank in Tacoma would call in its money from Seattle. Seattle would send a wire to San Francisco, and you'd get this money tightness and sometimes a panic throughout the area and sometimes throughout the country. But believe it or not, there was, this would happen to some extent every fall when the harvest season came in every farming community. And back then, farming communities held more than half the population of the United States. They were a very big part of the economy. The farming communities would need cash to fund the harvest, to pay field hands, finance equipment, grain houses, all of that. Cash would drain out of the cities, and there would be a mini panic. Rates in New York would go up to 100% sometimes. And Paul Warburg saw this very soon after he emigrated to the United States, and he was absolutely astonished. And I want to take you now to an episode that shows his reaction right after he moved to New York. Warburg was shocked by the primitiveness of American finance. Whereas banks in Germany functioned with near military cohesiveness, banking in America, he concluded, suffered from an ethos of extreme individualism. As credit tightened, each bank pulled its loans, thereby accentuating the scarcity for all the rest. In 1903, soon after a plunge on Wall Street, Warburg led on to Jacob Schiff, his brother-in-law and the senior partner at Kuhn-Loeb, Warburg's firm, that he had penned some thoughts on the defects of American banking and how to cure them. The key problem that Warburg outlined was the lack of a central reserve. Schiff read Warburg's paper and agreed with the substance of it. However, Schiff said, Warburg had misread the psychology of the American people, who would never accept any institution resembling a central bank. He warned his junior partner not to share his paper with others. But, as a teaching exercise for his protege, he offered to show the paper on a confidential basis to a well-placed friend, James A. Stillman, who was president of the National City Bank, forerunner of today's Citibank, and one of the prominent bankers in New York. A day or two later, Warburg looked up from his desk and found Stillman looming over him. Stillman was a man of legendary laconicism, highly eccentric. He was silent now, looking at Warburg through half-closed, heavy eyes. Finally, adopting a tone of gentle sarcasm, Stillman spoke. How is the great international financier? He added somewhat defensively, Warburg, don't you think Citibank has done pretty well? Warburg agreed that it had, very well indeed. Why not then leave things well enough alone? Warburg hesitated to reply. He knew how powerful Mr. Stillman was. Finally, though, he said, your bank is so big and so powerful, Mr. Stillman, that when the next panic comes, you will wish your responsibilities were smaller. Stillman went off in a huff, and Warburg went back to his work. Warburg had stumbled on what was really the original American conflict between federalism and anti-federalism, between big government and small, large banks, not large banks, and this goes all the way back to the beginnings of the Republic, 1791, and the famous conflict between Alexander Hamilton and Thomas Jefferson. Alexander Hamilton wanted a national bank as existed in England. Thomas Jefferson was basically a farm boy, didn't like banks, really didn't like big banks, didn't trust bankers. They both sort of took their case to George Washington in the early years of Washington's presidency. Washington sided with Hamilton, thought he made a lot of sense, and there was an institution called the Bank of the United States. It was sort of a prototype Federal Reserve, but this mistrust of it, particularly among rural people, people away from the East Coast, remained, and after 20 years, Congress got rid of it. And very quickly after that, the country had a very bad inflation. It discovered it needed a bank, and so James Madison and the Congress chartered the second bank of the United States. Went through the same thing all over again. The second bank was really quite a success. Before the second bank, America had had a polyglot of all sorts of currencies that, each bank in every state issues its own currency. The second bank rationalized this. It organized the debts of the country. It got the young republic on a more sensible and organized footing, but Andrew Jackson didn't like national banks any more than Thomas Jefferson did. And so in the 1830s, the second experiment in national banking was abolished as well. Around that time, Alexis de Tocqueville, the famous French political scientist, came to the United States, and he was just mystified at the venom that Americans held for the national bank. He wrote in his famous book, Democracy in America, that Americans seemed to be obsessed with one great fear, which he described as a fear of centralization. And Paul Warburg, as he settled into America, was adjusting to that very same attitude that really hadn't changed a whit. Warburg didn't defy Schiff, but he began to study the system more, to talk up his ideas, at least quietly, in small groups. He decided that the American system was like a town in which every home had a pail of water, but there was no fire department. And that might have been fine if you wanted a drink of water, but it wouldn't have worked very well if there was a fire that you had to put out. Because there was no central bank, every individual bank had to keep more of its reserves in its vault in case there was a crisis that would force it to close down. So they lacked the benefit of collective security that the banks in centralized systems in Europe had. Warburg began to expound this doctrine. Towards the end of 1906, he became very worried about the financial outlook in the United States. He was invited to a dinner at the home of a Columbia University professor in New York, a man named Edwin Seligman. Most of the people at the dinner were economists and bankers. Warburg began to hold forth on what he felt were the risks facing the country and to diagnose what he felt were the ills in the American banking system. People were completely mesmerized. And at the end of the evening, Seligman, his host, said to Warburg, you have to write, you have to publish, you have to tell your new country about all this. Warburg said, impossible, my English isn't good enough, and so on. But the next year, something happened that there was a terrible panic in the American banking system, and suddenly everybody wanted to hear about Warburg's ideas. Just as Warburg had predicted to James Stillman some years earlier, when this panic occurred, the biggest bankers in New York, people like Stillman, people like J.P. Morgan, were thrust into the center of it. They suddenly had the job of deciding which weakened banks were worth saving, which banks couldn't be saved, how to organize loans for the banks that should be saved. This, of course, was work that Ben Bernanke and the Federal Reserve did in 2008, but there was no Federal Reserve in 1907. I thought we might join the action now during the middle of this panic when it struck an institution called the Knickerbocker Trust, a fairly large-sized bank in New York. Morgan and Stillman have sent an underling by the name of Ben Strong to go over the books of the Knickerbocker and to make a report. The Knickerbocker was housed on 34th Street and Fifth Avenue in an opulent Corinthian column temple designed by Stamford White. The sidewalk in front was besieged by a mob of depositors, some of whom bore satchels with which they hoped to carry off sackloads of cash. Inside the bank, stacks of green currency bound into $1,000 lots were piled on the counters besides the tellers. As Ben Strong went over the books in the rear of the bank, he could hear depositors in the green marbled public area clamoring for their money. He later wrote, "The consternation of the faces of the people in that line, many of them men I knew, I shall never forget." By a little after noon on Tuesday, October 22nd, the Knickerbocker had paid out $8 million. It then suspended operations. Strong reported that he could not, in such time, vouch for the Knickerbocker's solvency. J.P. Morgan, therefore, decided not to intervene. In letting the Knickerbocker fail, Morgan knew he would be unleashing frantic runs on every other trust in the city. New York's trust, over a matter of several weeks, lost a remarkable and a devastating 48% of their deposits. Even worse, at the end of October, the local Clearinghouse Association of New York banks was forced to take the drastic step of authorizing banks to settle accounts with one another via certificates, paper substitutes for money, things they had invented overnight, rather than with cash. The panic had now reached epic proportions. As the panic spread, clearinghouses and bank associations in scores of other cities minted their own versions of invented money. By mid-November, approximately half of the country's larger cities were using loan certificates or other substitutes for legal money. In some smaller towns, where no clearinghouse existed, local bankers improvised, setting up a temporary committee, as it were, on the front porch. And in 2/3 of cities with populations above 25,000, larger cities, banks suspended cash withdrawals to a greater or lesser degree to ordinary depositors. For example, in Council Bluffs, Iowa, a limit was imposed of $10 per customer. In Atlanta, $50 a day and $100 a week. Banks in Providence, Rhode Island adopted a convenient policy of discretion, vetting withdrawals on a case-by-case basis. Even though the clearinghouses and their invented certificates, their substitutes for money, provided a measure of relief, they were generally recognized only in their city of issue, which was a serious drawback. A New York banker lamented that checks on Philadelphia, Boston, and other banks sent for collection are being returned. Money, in fact, traded at a premium. Those who needed cash were forced to write checks for more than 100% of the desired sum. Money lost its normal fungible characteristic. It was suddenly worth more in one place than in another. And at this point, Stillman, the banker who had rebuffed Warburg some years earlier, feeling that the American system was so strong and viable, began to experience a change of heart. And we'll follow him now just in a brief exchange as he makes his way to Kuhn Loeb. Several weeks into the panic, Stillman ventured the short distance to the offices of Kuhn Loeb. Unannounced, he made his way to the emigre banker he had first met 4 years earlier. He found him there, as he was before. "Warburg," he barked, "where's your paper?" "Too late now, Mr. Stillman," Warburg replied sadly. "What has to be done cannot be done in a hurry. If reform is to be secured, it will take years of educational work to bring it about." Towards the end of that year, as the panic began to subside, Warburg finally got the audience that he'd wanted all along. Financial reform in the US Congress was really controlled by one man, a senator named Nelson Aldrich of Rhode Island. Aldrich was a defender of the status quo. He was very conservative, He was very close to the business establishment. He had always in his career been opposed to a central bank or really any sort of significant reform in the banking system. And since he was the chairman of the finance committee, he called the shots. But the panic of 1907 disturbed him, and he began to wonder for the first time whether he should look into at least the possibility that the system might need some sort of change. Aldrich made inquiries on Wall Street, and he found his way to Kuhn Loeb and to Jacob Schiff's office. And he came with really a very narrow question. He wanted to ask Schiff about how the central bank in Germany issued treasury bills. Schiff immediately recognized an opportunity and said that there was someone else in his office who was more qualified to speak on such matters, and led the senator to Paul Warburg's office. So for the first time, now almost 10 years after he arrived in the United States, Warburg was face to face with someone who actually had influence and power in the US government. Aldrich kept his questions narrow, but Warburg began to tease him into the broader subject of broad reform and even centralization. Aldrich, perhaps just to get out of the room and be on his way, told Warburg that he should feel free to send him material for further reading. After Aldrich left, Schiff, once again, the man of caution, advised Warburg that he'd be making a grave mistake to write anything further to Aldrich, The very next day, Warburg sent Aldrich a paper called A Plan for a Modified Central Bank. 4 days later, he wrote to him again. The volcano was now uncapped. Aldrich did not write back, but Warburg had clearly made an impression on him. The next year, in 1908, Congress created something called the National Monetary Commission to study the defects of the American system and possibly recommend reforms. Aldrich was named the chairman. On the floor of the Senate, he said something that betrayed the impression Warburg had made. Aldrich referred to, and I quote, thoughtful students of the American system, thoughtful students of economic history who are led by the experience of other commercial nations have been led to conclude that we should adopt a central bank. And for political cover, Aldrich quickly went on to add that he did not think America was ready for such a step, but he said someday it would. And that was a very significant step for a public figure to make. That summer, Aldrich led a congressional study tour, a National Monetary Commission, on a trip to Europe to study the systems of Europe. He hired a Harvard professor to tutor them on board. They spent weeks in London and Paris and Berlin. And the heart of their investigations were interviews with officials at the Banque de France, the Bank of England, and the Reichsbank. The Aldrich delegation was really focused above all on one question. In America, banks felt this need to keep all this reserve money in the till, lest some panic come, of course, and they be forced to close their doors. They wanted to know in Europe, where there was a central banking system, how was it different? How did the banks operate? And for the last reading now, we'll join Aldrich and the commissioners as they make their way about Europe. At each central bank, the Americans were given to feel like the representatives of a primitive system, one barely above contempt. Their astonishment at what they heard, and by the way, the minutes of these meetings were all available to me, the astonishment at what they heard was palpable. The Europeans portrayed their institutions as effortlessly superseding parochial or private interests. Their policies seemed universally accepted. The interviews, of course, took place at the apogee of the social harmony of pre-war Europe. Had Aldrich gone to Europe in the 1920s, much less than the 1930s, the picture might not have been so harmonious. Aldrich pressed their hosts on the question of reserves. Who held them? What were the requirements? What were the rules regarding the holding of cash? The Europeans' consistent response, phrased in varying ways, was that the confidence reposed in their centralized systems obviated the need for the rigid regulations of American banking. London bankers could not relate to the American fetish with elasticity. How then, the Americans wondered, did the Bank of England adjust the currency supply to meet the demands of commerce? It was in France where the visitors were truly humbled. Aldrich explained that in the United States, the question of the proper relation between cash in hand and liabilities is considered very important. What, he inquired, was the rule in France? What portion of deposits were backed by cash reserves? Monsieur Pelin, the governor of the Bank of France, shook his head with a weary sigh. I think, he said, you pay more attention to the quantity of reserves than to the quality. But surely, Aldrich pressed, France had laws, regulations, some stipulation governing the proper proportion. No. The reserve requirements so dear to America, Monsieur Pelin replied, were insignificant in France, and I quote, on account of the facilities offered by the Bank of France for the rapid conversion in a crisis of banking assets into ready money. The Americans persisted. What, they demanded, determined the fluctuations of the volume of notes? Monsieur Pelin, despairing of his ability to explain the power of his central reserve to these stubborn Yanks, waxed philosophical. It is the sun, he said, or perhaps it would be more correct to say the alternating seasons. Now, when the Monetary Commission came back, they held hearings led by Aldrich in New York City. Warburg was invited to give a presentation. He spoke, of course, in favor of reform, but by now he was quite discouraged by the climate of the American public and the ability of reformers to go too fast, too quickly. So he gave a rather a pitch for a rather modest proposal, piecemeal and so on, so as to not alarm the public. When he was finished, Aldrich came over to him. Mr. Warburg, he began, I like your ideas. Remember, Aldrich has just returned from Europe. I have only one fault to find with them. Warburg, momentarily stunned, asked about the fault. Aldrich shot back, you are too timid about it. You say we cannot have a central bank. I say we can. As Warburg was to recall in poignant terms, and I quote, it is easy to imagine, but hard to describe, the mixed feelings of joy and bewilderment into which this remark threw me. For the first time, I felt confident that genuine banking reform was within grasp of the United States. I don't want to give away too much of the story. There were many twists and turns down the road for Messrs. Aldrich and Warburg and others, including an incident that some of you may have heard about, but a stranger than fiction trip to a remote island where, feeling that the idea of a central bank would be so unpopular, they actually cut the first draft in secret. And the story passed to the Democrats soon after that, and to Woodrow Wilson, and to his own efforts to get legislation passed over the objections of many people in his own party, and in fact, his own party platform. I'll only say now, we can deal with any of this in the questions, that Warburg was very right to be wary of the public response. I think Warburg, who, by the way, went on to be one of the Fed's first governors, and as he got caught up in this battle, he changed his citizenship and went on to join the Federal Reserve when it was formed in 1914. I think today he'd feel, unfortunately, very much at home in the climate that we have politically today. There are bills specifically in both houses of Congress that would strip the Fed of its independence, subject monetary decisions to the whims of elected officials, and keep the central bank from making the sometimes very tough and sensitive decisions that it has to make. But there's one difference that I'd like to point out between then and now. In 1913, in the period I wrote about, there were tremendous conflicts politically, sectionally, culturally. Bankers didn't agree with farmers. Bankers on Wall Street didn't agree with bankers in the countryside. Republicans and Democrats were split. Perhaps most of all, people in the eastern seaboard and the big cities of the Northeast were very much at odds with people in rural areas and the rest of the country. Nonetheless, the people who felt deeply about this issue were able to study it quite intensively for a number of years. They studied it, they debated it, they cut through their differences, and they arrived at an enduring and salutary solution. When I look at the political process today, I'm not so sure that we can still do that. So I want to thank you very much, and happy to take questions. Right, I guess take turns going up to these mics.
Is it true that the Federal Reserve lobbies not to be audited? And if so, why do they not want to be audited?
The Federal Reserve is audited by the GSO. The bill that Rand Paul has submitted to the Congress called Audit the Fed would call for their monetary decisions, so their basic decisions about interest rates going up or down, buying bonds or selling bonds, and so on, to receive basically day-to-day scrutiny by the Congress. So in terms of what's on the books, the Federal Reserve, what their assets are, that's public, and not as public, it is audited. Audits the Fed is a pretty inflammatory word, and it's helped sell a couple of books. But it's really about subjecting the Fed to the political process.
And when do you expect them, or when do you think they should raise rates again, and why?
You know, Janet Yellen is in a tough spot. In the Paul Warburg era, the Federal Reserve was limited by the amount of gold. The circulation was limited by the amount of gold, and now the circulation is limited just by whatever the 7 governors and 5 other members of the FOMC decide. Obviously, they'd like to raise rates. It's not a good idea for money to be free. It's a distortion. It makes it too easy or it overly encourages people, presumably, to make investments. On the other hand, the economy keeps sending back the wrong signals, and the rest of the world's economies are basically going the other direction. The U.S. faced this in the 1920s, when the Federal Reserve was very concerned about a depression in England. They didn't want England to lose gold and go off the gold standard. So we lowered rates really to help out England, and that really resulted in the final stage of the stock market boom in the 20s. So, how much Janet Yellen pays attention to the rest of the world, I think she's got a real problem, because if she doesn't do it soon, she's going to get into the election season, and that's going to make it tougher. I haven't answered your question, though. Yeah. Yes.
Hi, I wanted to ask you about large banks that borrow overnight with other large banks or the Federal Reserve, and their modern IT systems. Are they doing that to balance their books, to have the right reserves? Because it's changing every 24 hours. Is that how it works?
They're doing it because some are short and some are long. Some need more and some have a surplus. The reserve requirements, it wouldn't be necessary for a bank to be below its reserve requirement to feel that it wanted to borrow more, because you don't want to get down to your last dollar before a reserve requirement. And particularly now, when the federal funds rate is so low, what is it, 5/100ths of a percent, it costs virtually nothing to have more cash. The big problem that faces banks, large and small now, isn't a lack of cash, it's a lack of places to put it. And that's why rates are so low. There's an excess right now.
Oh, I just wanted to ask you quickly, do you have any comments on quantitative easing, or how the Fed's going to run off all the securities they have?
Well, quantitative easing was the program that Bernanke instituted. Unlike the normal policy of the Fed of buying Treasury bills, short-term securities, it bought longer-term securities. And it still holds about $4 trillion on its books. And it really has 2 choices, or I guess it has 3 choices. It has 2 choices. It could at some point start to sell them off, and just as buying bonds stimulated the economy, or worked to stimulate the economy, selling them off could have the opposite effect. Or it could just wait till these bonds mature and let it run off over time. My guess it'll be some mix between the 2. I would doubt they'll unload $4 trillion as quickly as they bought them, because they wouldn't want to send the country back into a recession. Thank you.
My name is John Yost. I sit on the board of Seattle Housing Authority, and I'm for the poor and also too for the middle income. Now, I have a question for you, because Alan Greenspan basically said that we can print unlimited greenbacks because we have our own central bank, and also too because we have the Federal Reserve branch. Now, how do we expect that our economy, Main Street, and also too our Wall Street to exist and to continue with this $17 trillion deficit? Now, you know, as we know, we all, maybe most of you are not struggling, but if this continues, we will all struggle, and there might be breadlines and things like that.
So let me just, I think you've asked a couple questions. Let me start to tackle them.
Yes.
Okay. So the debt that people talk about, the federal debt, is, you know, the difference between what the federal government spends each year and what it takes in taxes. And it's actually, it's 3% or something now. It's not a big deal. It's not a terrible thing for the government to borrow a little more than it spends each year. It borrowed a lot more during the crisis, and that's not terrible either, because that was a good time to stimulate and to be spending more and getting it out there. But that's fiscal policy. That's the realm of, you know, what the Congress takes in, what it spends, what the Treasury does. Basically tonight we're talking about monetary policy, what the Federal Reserve in effect prints and stimulates. And you sort of talked about two risks, and they really go in opposite directions. One is the hardship that people who are on the middle or lower end of the ladder, the hardships that they face, lack of good jobs, lack of affordable housing, all of that. And the other is the risk that if the Federal Reserve prints too much money, you know, if they just start handing it out on the street to people who need it, obviously the money would stop being worth anything. So it's not so easy to say, well, you know, we should just print unlimited amounts. Greenspan may have said that, but he didn't mean it, and he didn't do it. He may have printed more than he should have at times. It's not an easy job. But it's not just a question of printing unlimited amounts, because that won't help the people you're talking about. You know, a good example, I think, was there was a lot of pressure on the government to make loans, housing loans, cheap and easy in the early years of the 2000s. And that was a nice idea, but if you make, at the end of the day, loaning money to people who can't pay it back palpably, as bankers who got reckless began to do, loaning people 100% of the purchase price, making loans to people without asking to see if they really had proof of their assets. That didn't end up helping them, and didn't end up helping the banks, didn't end up helping anybody. We had the crisis. So these things, I think, involve a fine line and a lot of compromise. I'm going to let the next question, because that's. Thank you.
I was wondering if you believe that the Federal Reserve was instrumental in nationalizing the debt of the investment banks in this last housing bubble, and if so, you know, and basically passing that debt on to us. And if so, whether it's fair to question the constitutionality of allowing a semi-autonomous organization like that to have that kind of power.
Well, the constitutionality of it was questioned before the Supreme Court in 1918 or 19, McCulloch versus Maryland, and they said it was constitutional. The actions of the Federal Reserve, say in loaning money to AIG, Congress, some years into the Federal Reserve's existence in the 1930s, loosened up the terms under which the Federal Reserve could lend money to non-banks, such as AIG. They did that because the Federal Reserve's efforts during the Depression were notably ineffective. We had employment go up to 25%. It lasted the better part of 10 years. People thought if we were going to have a Federal Reserve, it ought at least be more effective. So under that provision, which I believe was legislated in 1935, the statute calls for exigent circumstances and so on. They could do more. The Dodd-Frank Act, by the way, passed after the crisis, restricts the Fed from doing that. It's not clear now if we had a future crisis and there were an AIG about to go down, whether the Fed could make that loan. In my belief, that was make that restriction was a grave error. You don't want fire departments using too much water, but to tell them ahead of time if there's a fire, it's the fault of the people who were reckless with matches, and they ought to learn how not to start these fires. It's a really tough medicine in the middle of a crisis. You're going to get a lot of blocks that burn down. The money that went into the banks, I just want to point out, was mostly from the Treasury Department under the TARP bill. And that also obviously was authorized by legislation. You have to, there's an old saying about there's no atheists in foxholes. It's real easy to be hung up on a theoretical point when we're standing, on a nice night, in Seattle. But when you're in the middle of a crisis and bank after bank is going down, and there's a run on the money markets too, and unemployment is shot up to, above 10%, going who knows where, and 20 million Americans are, over their necks in mortgages they can't pay back. I'd be in favor of letting the public officials have license to address the problem, not to have another Great Depression, which I'm thankful we didn't have.
I thought the Federal Reserve was not a public agency, though.
It is a public agency. The Federal Reserve is,
Not according to the courts.
the Federal Reserve Board in Washington is very much a public agency. The reserve banks themselves are under the dominion, the individual reserve banks around the country are under the dominion of the Federal Reserve and subject to it. They pay dividends to their shareholders, who are the private banks. But the Federal Reserve as an organization and its leadership, its operating entity, the Reserve Board, is every bit a public agency. It was created by an act of Congress, and Congress could uncreate it in a pen stroke tomorrow. It is every bit a public agency.
So then it's appropriate for them to be engaging in a fundamentally political decision to,
Well, and this is going to be it because we're getting into debate, but everything that any politically created body does is ultimately political. After all, the people who are on the Federal Reserve were appointed by the president, one president or another. So ultimately, they're going to be political, the same way that people in any agency were appointed by the people at the SEC, the FCC, whoever you want to name. The reason that we have an agency structure is to create some level between them and the people running for office. So you don't have, congressmen running for office promising people, cheap interest rates and cheap money as a way to get elected. That probably wouldn't be a good way to run the monetary system. But the point you ask about was very much at issue in 1913. We didn't have public agencies, really, except for the Interstate Commerce Commission. That was the only one that existed then. And so the idea of subjecting a private industry to public supervision was very radical. The first draft of the Federal Reserve Act had bankers on the Federal Reserve Board, chosen by bankers, and William Jennings Bryan, who really had gotten Wilson his nomination, and because of that was Secretary of State, and although he had lost 3 elections, was still very popular among Democrats, said that was wrong. If we were going to create this new supervisory institution, he said, the people on it ought to be public servants. All of them should be appointed by the president. And he threatened to resign. And that would have not only taken down the bill, it would have taken down the Wilson administration because Bryan was so popular. Wilson went to an advisor, later a very famous advisor, not quite yet, Louis Brandeis. And he said, I'm in a pickle, what do I do? And Brandeis said, you're really not in a pickle because Bryan's right. This is a public entity, and these new governors of this new institution should be responsible to the public, so you should nominate them, and that's what happened. Thank you.
Thank you for the time this evening. This is more personal and professional, but as someone who has been steeped in the Federal Reserve and the history, current, present, and ideally future, do you have any book reviews as a student? Something that you have read other than your own publication that you think would be a wise read for the current political and economic crisis or situation? What book would you recommend?
Well,
what's on your bedstand?
Well, if you want books on financial crashes or so on, I really like The Great Crash by John Kenneth Galbraith. If you want a book that explains how world trade works and the tensions between people who want to put up barriers and people who'd like to see trade be liberalized as much as it is and maybe more so, there's a wonderful little book by an Italian economist who works in Washington called The Travels of a T-Shirt. Reads like a novel, believe it or not. I could think of more, maybe if you come over afterwards, but those are two I really like.
Thank you so much.
Good evening. When did we come off the gold standard, and what were the effects?
So we,
If let me say, if after answering these other questions, I'd love to also hear the difference between Glass-Steagall and Dodd-Frank.
So we came off the gold standard really in stages. The issue with the gold standard was that the Federal Reserve, the U.S. government, was promising to back every dollar with gold. And that meant it couldn't issue more dollars than it had gold. And to attract gold, it began to raise interest rates in the heart of the Depression. And that, of course, had a very punishing effect on the economy at the worst time. And Britain actually went through the exact same process. They were on the gold standard as well. In 1931, they went off the gold standard, which put pressure on us to go off it as well. And Franklin Roosevelt took us partway off because he closed the gold window to citizens. So people could no longer take a Federal Reserve note down to the branch of the Federal Reserve and turn it in for gold. However, foreign countries still could. The gold system wasn't really operative in the Depression years or during World War II, obviously, but we sort of were in a half gold system in the 50s and 60s, and the idea was we just printed whatever money we printed and used that in America, but as dollars went overseas, Europeans had the right to come back, Asians, other countries too, and to turn in their dollars for gold. And that system worked until we had an inflation in the late 60s, the Vietnam War and so on. And the French, for some reasons of their own, they were feeling nationalistic and didn't want the dollar to be king of the hill. They began shipping us dollars and demanding gold. And so Nixon one day stunned the world and said, the window's closed. You can accept dollars, or you can use dollars or not, but if you come here and say, Federal Reserve note, we're going to turn it in, we'll just give you the same Federal Reserve note right back. That's all it's worth. And actually, his Treasury Secretary, John Connally, at that point, put a nice twist on it. He said, the dollar is our currency and your problem. He was speaking to other countries. What's sort of interesting is that the expectations were that the dollar would completely lose credence. Nobody would want it. Since we'd been so humiliated, it would be replaced by, first the mark, then the yen, then the euro. This was said again during the Bernanke era when there was so much stimulative activity, creating all these dollars. But in fact, the dollar has maintained its purchasing power, and more so on world markets. Really, the reason people have faith in the dollar, really two reasons, is because it has purchasing power in the United States, and because it's based in a country where the laws and legal system are trusted, and there's a transparency so that, for instance, some people have suggested that the Chinese currency will be the new reserve currency, but no one really knows how much Chinese currency is out there. No one knows what the debts or the assets of the Chinese central bank are. They don't have the same transparency yet. They may get there someday in their system that we have. So it's the dollar's intrinsic strength really rests on the strength of the American economy and system, and the lack of a gold backing hasn't affected it at all. Just very quickly, Glass-Steagall, Carter Glass was the founder of the Federal Reserve Act. I didn't have time to get into him. And in 1913, later in his career, he was a co-author of Glass-Steagall, which separated banks from investment banks. And that was eroded and done away with in the 1990s. Dodd-Frank doesn't really touch Dodd-Frank is a series of regulations that try to restrict banks and tries to stop what just happened in the mortgage crisis from happening again. That's Dodd-Frank. Dodd-Frank was passed in 1910, very recently. Yes, sir.
Yes, thank you so much. Very insightful. Couple of related questions. It's a two-part question. First, in the 32 years following the passing of the Act in 1913, we had 2 world wars. We had the Great Depression, Social Security in 1935. It's sort of a what-if question. Like, how do you think American history would have changed if we didn't have the Federal Reserve in that period? And the related question is, given the lessons of those 32 years across the board in terms of public policy and what happened across the globe, how do you think the Act might have been amended or changed if the sort of creators had been able to foresee all the changes in those years?
You know, I can't look at 100 years what would happen without it, but one flaw in the Act, I think, was they were so concerned with not offending people who didn't want a central bank, and also wanting to achieve Warburg's purpose, which was to create this one reservoir, that they sort of struck it halfway by having these banks around the country, the Federal Reserve Bank of San Francisco, the Bank of Atlanta, and so on, all 12 of them, and also having a board in Washington. But they were very vague about where the power would reside in the system. And when the Act was passed and became law, immediately there was a struggle, really, between 3 parties. The individual Federal Reserve banks, led by the strongest one, which was the one in New York, the board in Washington, and the Treasury Secretary, who for the first couple of decades had an automatic seat on the Federal Reserve Board. And it was quite unclear as we went into the Depression who really was responsible for policy. Some people felt that, after all, the Federal Reserve Bank, the banks were the banks around the country, and that the board in Washington was just supervisory. Others thought the board should really be the engine of decision-making, an effective agency. And others thought that the Treasury. And if you read the notes from that period, you see some of the bank presidents were lowering rates, some weren't. In particular, Atlanta was very dovish, and actually the Atlanta district did much better than the rest of the country for a significant amount of time during the Depression. But there was no one person, such as Ben Bernanke, in 2008, who said, we have a real problem, someone's got to act in a concerted way, and that someone's going to be me. And over time, the battle kept going on as late as during wars. The Fed tends to become sort of a handmaid in the government. The government wants cheap financing, and the Fed tends to go along with it. And this happened after World War I. Into about 1951, the rates were still very low, 2%, and it became clear that the Fed thought it was time to let rates go up. Harry Truman was just aghast. He didn't understand or accept for a moment the idea of the Fed being an independent agency. And when he couldn't get his way in private, he announced publicly that the Fed had agreed to keep rates at 2%, which they hadn't done. And he fired one of the board members, appointed someone else from the Treasury who he thought would be, his pigeon on the Federal Reserve Board. But at that point, the Fed insisted, and they wouldn't back down. And from then on, it's been a more independent agency, and powers been more based in Washington. I will say that one effect of the recent crisis is that the Federal Reserve has worked much more closely with the Treasury. Bernanke and now Yellen, they meet often with the Treasury Secretary, with the President. They're coordinating Federal Reserve policy with the government, which might be appropriate for a crisis. But I think at least till now, and until at some point Janet Yellen is going to have to tell Jack Lew, the Treasury Secretary, that she's running the Fed, even as he runs the Treasury, or the Fed's independence will be compromised. Thank you.
Yeah. Do you believe that the extended period we've had, historic period of 0 interest rates, is leading to asset inflation instead of conventional inflation? And could that have, and if so, could that have negative repercussions?
Well, if it is, it'll have negative repercussions. You know, it's just hard to tell. I mean, it's hard even to tell how distorted they are because, you know, there's a lot of capital out there. So if you said, well, let's have rates at a more natural level, you know, what would that be? It's you know, I doubt it'd be up to 6%. There's a lot of capital, and there aren't a lot of people who want to go out and build and borrow and, you know, invest. We're you know, not in a very swift economy. I mean, so it's possible, but it's really hard to know these things. There aren't any, to me, obvious bubbles where, you know, as with the real estate crisis, you know, not that I said that was obvious then, but these things are easier to see in retrospect. And there's no internet. I mean, there's some speculation in Silicon Valley, but not like we had in 1999. So, you know, yeah, probably some inflation. I will take anyone else who hasn't asked a question. I will take one more from this gentleman, then happy to sign books.
I just wanted to follow up on something you said earlier. I thought I heard you say that since the abolition of the gold standard, that the dollar has not lost any of its buying power.
No, I said it hasn't lost its power overseas in world markets. It's obviously there's been inflation. There was a terrible inflation in the 1970s. The rate of inflation, though, generally has not been severe. I mean, it's lost about 2% a year, except for that period. And it's true that, you know, you can look at these figures like the, you know, $1 in 1920 is only worth, you know, 14 cents today. It's, you know, and that's real significant if you're around in 1920 and you're still around today, and, you know, but life doesn't work that way. What happens is, you know, at a 2% rate, it's barely noticeable. In some ways, it's even helpful. Well, you know, one reason we have unemployment is because for cultural reasons, it's very hard to cut people's wages. It's just, you know, companies would rather cut 10% of their workforce than give every worker a 10% cut. It's just very hard to tell someone when they come in. But if there's a little bit of inflation, then there's a sort of a silent way of cutting wages by just not giving them a raise. And then, you know, there's a little bit of inflation is probably healthy. But I didn't say that there's been no inflation. Obviously, there has been. It certainly does. So thank you all very much for coming out tonight.